This is the end of day Emini review for October the 28th, 2022. And today was a small pullback bull trend. And the interesting thing about today was the market actually maybe had one close below the moving average. So if we look at, let's see here, 93. So there's one close below the moving average. So really the market had really just one close below the moving average. And that is not common for the daily chart. I don't know why it does that with me. We tried several times to break below the June low, this blue line, and on October the 13th, we had a 5.5% range day and a very strong rally, 50% pullback. That has led to a rally and test of the September 21st high. And arguably, that is, you can call that exhaustion, you can call it the final leg. Here, this is probably strong enough for this to be a major lower high. Market broke above it, and we're forming a gap. And the bulls want some kind of measured move up, which measured move from the October 13th low to the October 5th high takes you all the way back to the August 24th low. And I still think this is a magnet. On the Globex, we closed above it, but on the day session, we did not. And it's an open gap, and it'll probably close. I do think we're going to get to the 4,000 big round number over the next couple weeks. As weak as this rally is, it's tight and it's forming an obvious measuring gap here. So that is a sign of strength, and the market could easily break out to the upside and test here. It's common in a trading range for the start of the rally to look unclear and look like it may fail and test back down. And right now, we're getting more buying pressure. 3 consecutive bull bars, strong bull bar here. Even if we get to 4,000, we're still in a large trading range, and the market could still test lower. This is a monthly chart. And on the monthly chart, we have the bottom of this trend line. We tested the trend line in 08. We tested the trend line in 2020. And we could easily test this same trend line. And if we do it over the course of several months, if we rallied and sold off, obviously this trend line will get higher. So it's possible we can get down to 3,000 or 3,300. I think it's very reasonable we get down to the 2020 pre-pandemic high, but overall trading range and probably buyers somewhere below. 60-minute chart, lots of consecutive bull bars. Probably on Monday, we'll get a bear bar. This is extreme. And it's 7 consecutive bull bars and an 8-bar bull micro channel. This gap was strong enough to lead to a measured move up. So on the open, you do it like this. Bar 1, strong bull bar, gap up, probably always in long based on the gap and bar 1. In general, most traders would rather see consecutive bull bars. Bar 2, consecutive bull bars closing on its high. And let's see at this bar 42.50, 42.25, closed one tick above bar 1 high. Always in long, probably strong enough for at least second leg up. Traders will buy this close, probably stop down here, betting on a second leg. Bar 3, tail on top, but 3-bar micro channel, probably buyers below. And you can see bulls bought the low of 3 on 4 and bar 4. is another bull bar. Now it's a high one buy, and the problem the bulls are getting is they're not getting bull bars closing on their highs. The past two bars, bar 4 and bar 3, failed to close at a new high. And bar 3, it went above, well, bar 3 closed above bar 2, but bar 4 did not close above bar 3 or even go above bar 3. And bar 5, now we have an II pattern, so you can argue it's, never mind, it's an inside bar. So possible final flag, and we could break to the upside and turn down. I do think we'll pull back. As strong as this is, it looks like it's a sign of weakness. And in theory, there's bears that sold down here, and they've never had a chance to get out break even. Obviously, the Globex market is not showing here, but it's kind of like this sell off. We gapped up here. We may have to test some sort of pullback. Bar 6, you can argue wedge 1, 3, and 6. Reasonable for traders to get out below bar 6. Some traders will try and buy down here. Strong enough breakout, probably a second leg, but we don't know how deep the pullback could be. It could easily pull back all the way to the 1 close. And 7, outside down. Some bulls giving up. We're testing the 73 high yesterday right here. Probably buyers somewhere below. Bar 8, an inside bar, but after 7 is a little bit of a surprise, may get a second leg down. 8 is a bad high one buy, so probably more sideways. Still always in long. Therefore, if I had to pick any direction, I'd pick long, stop below 1. And bar 9, testing the midpoint of bar 1. And the market found buyers. There were buyers below. Probably at least second leg up. 10, good bar for the bulls closing above 9 and 8. However, it's a tight trading range really since bar 3. Probably more sideways and not straight up. You do have to wonder about the possibility of a spike in channel. So spike, pullback, and channel. Bar 11, inside bar. Small micro gap, the 11 low and the 9 high. And 12, a breakout above the 6 high. 12 is the close of a 60-minute bar, and that 60-minute bar is right here. So the first hour closed on its high. Now, if you look at the 60-minute chart, we have a gap down and a strong reversal up. So this is enough to trap traders and probably get at least a second leg up, maybe test of the October the 26th high, which is somewhere over here. In fact, I'm just going to mark it because it's probably, I'll talk about it when we get there. So let me get back to where we were. There we go. 13, we triggered the 60-minute close by going above it. Probably will pull back just a little bit, but this is a micro channel, and the bears, they're not getting any selling pressure since over here. Some bulls sold this high scaling in higher. They may get trapped and they may buy back shorts. They'll certainly try and buy back shorts at the 7 high, but they may try and buy back shorts earlier than that. And that's what happened on 14. 14 was also, this was a strong enough breakout, although lots of tails, inside bars, not uniform bars, that lowers the probability. It's still strong enough for at least a second leg up, so traders would buy the 13 low and buy around the 7 high. So right here, this is a problem. This is a sign of a small pullback trend. So what is that sign I'm talking about? Well, we have an open gap. Open gaps are very dangerous. This looks like a leg, possible leg in a trading range. Now, this big gap up increased the probability of getting a rally. But whenever you see this right here, this should be a warning that bears might get trapped. Some bears sold this high, scaled in higher. Maybe they sold this high, they sold up here, they sold up here. They're unable to get out break even, and the market is breaking out to the upside. Those bears are going to be forced to buy back shorts. Because obviously, if they didn't buy back shorts, this is the risk they face. So 14, 15, 16, another strong breakout. It's possible parabolic wedge, 10, 13, and 16. However, it's tight channel, probably buyers somewhere below. 16 is a strong bull bar and it's climactic, and the market may pull back to the 16 low. It could pull back to the 14 high. Therefore, some traders will, it's reasonable for bulls to sell out of longs up here. And what about the bears scaling into shorts? I would not. I think I think the channel is too tight and better to wait for more selling pressure. 17 and 18. 17 high one buy. It's an inside bar. Probably sellers above 18, but the selling is probably due more to profit taking than anything else, and the pullback may be brief. Dangerous to sell up here. And 19, testing this target. If I lower the target to this high, you can see we went above it. So maybe that's the midpoint. But anyways, it's testing the midpoint. Outside down, 19. Probably buyers below. Probably will test the 13 high, which is a gap, or the 15 high. And you can see we came really close to 15 high, starting to turn up. 20, you can call it another high one buy. You can call it a high two buy. It doesn't really matter. It's a possible expanding triangle on a smaller time frame. We went down on 17, up, down, and up. So 1, 2, and you can say 1, 2, 3. If you look at 17, 18, and 19 on a smaller time frame, you will see 3 pushes up. In fact, let me just show it real quick. 10:05. Here you go. It's right here. So hard to see, but you can see 1, 2, 3, and 1, 2, 3. Let me just draw it kind of like this. It's not perfect, but close is close enough. And if I remove this and I remove this right here, change this to a 5-minute chart, there it is. 1, 2, 3, 1, 2, and 3. So if you can spot expanding triangles, if you can spot this 1, 2, 3, it can be a little bit of a warning that the market may form a trading range within the expanding triangle. So that could be a warning that this market will probably go sideways here. So what about buying above 20? Probably sellers above and more sideways. This is a lot of buying pressure on the open, and I really think, after consecutive buy climaxes here, here, and here, probably going to have to get closer to the moving average soon. 21, sellers above 19. However, what do you notice about this entire rally in terms of bull bars and bear bars since bar 9? There's really only been one bear bar ever since bar 21 to bar 9. There's only been one bear bar. Now there's been a few bars that close below their midpoints, but this is a lot of selling pressure, and the reality is, even if the market sells off here, it's probably going to have to go sideways. So better to wait for more selling pressure than get trapped trying to pick a top. The market can rally a long, long time, and the market's not climactic here. If you look back over here, let me find the day. Here's one. So if you look at this rally as a whole, it's very climactic, and it led to a sharp sell-off. There we go. So 21 failed to close above the 20 high and failed to close above the 19 high. So it's a wedge, 1, 2, 3. 22 23, forming a tight trading range. Probably will get to the moving average soon. Now, if we just go sideways here, the market will get pulled, the moving average will get pulled up. So that is one problem. Well, that's one thing for the bulls. As long as if we go sideways here, and the moving average gets dragged up, more and more traders will begin to start buying. 24. 24, 3 consecutive bear bars. 1, 2, 3. Is it always in short? No. The market hadn't even broken below this trading range, and it's really just tight trading range. We hadn't even really closed a gap, so probably buyers below. Now we have 4 consecutive bear bars. 1, 2, 3, 4. And let's see if this is a micro channel. And it's not a micro channel, but it's a 3-bar micro channel. And 26 broke below 20 and starting to reverse up. What about buying above 26? Well, some traders will buy above 26. However, tight bear channel and forcing traders to buy in the middle of a tight trading range, not really an ideal buy. If you do buy above it, better if you can buy more lower, like the 26 low, or somewhere down here, and be able to use a wide stop. 27, bull bar closing on its high. 28, another bull bar closing on its high. Probably strong enough breakout for a second leg up, but we're getting high in the range, and the bulls who bought up in here and bought more lower may use this rally to get out, break even. 29, you can call it a lower high major trend reversal, lower high with 21. However, the sell-off to 26 was minor. The rally up to 28 and 29 was only 3 or 4 bars, so really not enough to call it a major trend reversal. That lowers the probability that any sell-off will lead to a bear trend and increases the probability that any sell-off will be minor and lead to either two things. It'll lead to a trading range. Ultimately, it's really common for major trend reversals to be minor, such as this. Sell off, rally to a lower high, and then the market sells off further and forms a more complex correction, then rallies to test the high, and then forms a larger major trend reversal. That's kind of the same logic as an expanding triangle. On some small time frame, this is a higher high major trend reversal. Here's a trend line break, rally to a new high, deeper trend line break, a new rally to a new high, and you can see the correction's getting more and more complex. And then we rallied even further down. We sold off further down, and then we rallied to a new high just about. So now, here's the new trend line break, but this is not enough, which means probably buyers somewhere down here. 4 consecutive bear bars, good for the bears that are forming buying pressure. But the issue the bears have is every bear bar we've had so far has a lot of overlap. And this is the most dominant feature of the day, here or here. This is more dominant than this, but you still have to include this gap with this part of this rally. So probably it's still always in long, probably going more sideways to up. A lot of traders would rather see a deeper pullback or a deeper correction, but we haven't touched the moving average since really at any point today, except for here. And bulls will buy at the moving average. 33, strong bull bar, but forcing traders to buy at the high of 29. It's an okay swing buy. You're betting on a breakout of a triangle. 1, 2, 3, 1, 2. 34, 35, 3 consecutive bull bars. Probably buyers below it, at least second leg up. May have to test yesterday's high. Or it's actually the high of the 60-minute chart up here. 36, another close of the 60-minute chart. So you can see the market's had 3 strong closes. And they're right here. So 1, 2, 3. That's good for the bulls. Probably buy the close, stop somewhere down here, and the market will probably go higher. 38, bear bar. Some traders will exit long. We're so close to the high of the 60-minute chart, which was October the 26th. We'll probably have to get there, but we could pull back first. Some bears sold this high, scaled them higher. They'll be disappointed, and maybe they'll buy back shorts somewhere around 38.85. And you can see we're trying to test 38.85, and we're failing. That's because bears sold here. Maybe they sold more below a bear bar. So you sell here, you sell more below a bear bar, and that is your average entry price. Those bears were so disappointed that they wanted to just get out of the trade entirely at break even and not try and make a profit. 41 and 42, forming a tight trading range, double top with 39 or 37, 38. I don't know why it's doing that, but not enough buying pressure. If you think about it from the bear perspective, how hard is it to make money on a stop entry selling below a bar? It's really hard. Therefore, it's really better to wait for more selling pressure. Wait for the bears to make money on a stop entry, then a retest before traders look to sell. Possible wedge 1, 2, 3, 1, 2, 3, or 1, 2, 3. But not enough buying pressure. Not enough selling pressure. I'm going to zoom in. It's going to be more or less kind of the same. Tight trading range here. And as soon as we got to the moving average, broke to the upside and tight trading range. A lot of traders, the problem with small pullback trends is they're great for swing traders. And the issue with them is they're low probability events. If you think about it, a small pullback trend continuously traps counter trend traders. And what that does is it forces traders to constantly, if they sell, they get trapped and have to buy back shorts. And, they sell here, sell more higher, and they have to get out break even. They sell again here, scale in, have to get out break even. They sell here, scale in, have to get out break even. The bears can't make money. And the bears keep trying because, let me back up. The market gets exhausted, but then it goes sideways and relieves itself. It gets exhausted, but sideways and relieves itself. Gets exhausted, relieves itself. That is unlike really unsustainable moves. So what's an unsustainable move? It's like this. A lot of selling pressure, bears selling, making money. Strong bull bars, deep pullbacks, strong bull bars, and sideways. The market, if it moves too far too fast with a lot of selling pressure, it will limit the upside, and a lot of traders will take profits. And the reason for that is if traders see the market is too climactic, swing traders such as bulls will exit. They'll exit. And if we look at today, the market never became too climactic. Just think about always in. So how would we trade always in today? Well, bar 1 and bar 2, traders would buy the close stop down here. Really no reason to get out here. They would hold, stop somewhere down here. Strong enough breakout, need a trend line break and a retest. This is too weak. Strong enough rally, probably need a new trend line break and a retest. They don't get it here. All of these sell-offs are minor, and there's really no reason to exit for the entire day. And because of that, there's no clear gift. Let's see if we can find a day where we got a strong rally and then a gift. Let's say so here you go. This is kind of an extreme example. Breakout, trend line break, rallied to a new high, tried to form a major trend reversal, but too much buying pressure, and then very climactic behavior. And at this point, there's just nobody really left to buy for several bars. We tried to break to the downside, sold off, and we rallied. And even through here, the market was still able to go higher. So the point is, even when you get climactic buying and the market sells off a little bit, usually the sell-off is minor and just leads to sideways trading. So overall, with this kind of day, these are, again, low. These do not happen that often, especially small pullback trends that fail to get a close below the moving average. Therefore, for the most part, I wouldn't think much of this day. It's a strong day, and the problem with these days is that it gives the illusion that swing trading is really easy, and you just buy and you hold for the rest of the day, and you make 100 points. But that is not reality of most days. That's reality of 5% of days, maybe less than that. Most days are this: rally, reversal, but if you sell off and if you sell anywhere, you have a deep pullback and the market goes sideways. Let's just go to a random time. Let's go to here. So let's find the next day. Okay. So big bear bar. Well, let's say you sell the close, or you wait for consecutive bear bars. Okay, so you sell, and what do you do here? I think if I remember this day, it actually sold off for a good portion of the day. But either way, it's not that clear. If you sell here, do you get out above here? Do you get in below here? It's not that clear. A lot of buying pressure in here. Now with this day, this is just one of those days. I remember, the only reason I remember this day is because it had a weird outside bar right here, and it formed a lot of buying pressure. But if memory serves me right, this measuring gap trapped traders, and the market tried to form several consecutive bottoms, and I think right here the market broke to the downside. This bar should have had buyers below, and the bulls that bought, they got trapped by this bar, and they never had a chance to get out break even. Now it's bad to buy here because you're at the moving average, but this market should have let those bulls out, and I don't think it did. Yeah, okay, that's what happened. So anyways, but the point is really hard to hold through this, and by the time you sell here, you're late in the move. It's 24 bars into a bear trend, so the sell-off may not last that long. And then if you sold here, do you get out above here, or do you wait? But if you sold here and you didn't get out quickly, now you're back to your entry price. But either way, the point is most days do not just simply do this. And the reason for that is bears keep getting trapped, and when they get trapped and they take a loss or they sell and scale in, they sell, scale in, get out break even, they don't want to keep selling again. So they're going to wait for a few bars. It's kind of like bears sell more, get trapped, get out break even or with a small loss, and maybe they sell, scale in, but they just don't make any money. And let's see here. So there you have it. So I hope you enjoyed this video, and have a good rest of your weekend.